From New York City for our viewers worldwide, I'm Matt Miller. We're looking to see if the fallout of Apple can drag the market along with it today. The countdown to the open starts right now. Coming up, stocks pulling back from record highs ahead of tomorrow's doubleheader. The Fed kicking off its two-day meeting. And Apple's AI plan is getting a lukewarm reaction from investors. Let's begin with the big issue, though. CPI is up next.
We see that trends in inflation are exactly where the Fed wants it to be. I think we're probably going to see some of that data tomorrow, where the trends continue to point towards that lagged effects going to deflationary that allows them to have that, flexibility they seek. The market seems to be pricing in too. And we believe that, the data will show that at least there's going to be one. The question is going to be September or December.
Joining us now to discuss is Cole Smead, Smead Capital Management CEO, famous Warren Buffett acolyte and in town from Phoenix. Great to have you here on the program, Cole. What do you think about the data that we're getting? Inflation looks like the acceleration we saw at the beginning of the year was a blip, and now we could come back into disinflation, and growth continues to be fairly steady.
Yeah, I feel bad for the Federal Reserve because they're dealing with a problem they didn't create. We're spending 7% of our GDP. We've never done that before with less than 7% unemployment. And as we all know, we're dealing with something closer to sub 4. So it's a situation where, we're trying to deal with the symptoms, but the ultimate problem is federal spending. And I don't think that's going to change with Biden or Trump in the presidency. It's very popular. I have a friend running for Congress in the great state of Arizona, and you cannot get elected telling people you're going to cut benefits. And ultimately, Social Security, Medicare, Medicaid, that's going to grow next year whether we like it or not.
Well, what does that mean to you as an investor? If debt and deficits continue to grow, obviously the carry costs are more expensive now than they were before, and there are no cuts or fiscal responsibility in sight.
Yeah, that's a good question. In our economics class, we were taught about guns and butter. That was the old, economics lesson of the 1960s and 70s. It ended up just being butter, ultimately. If you look at Vietnam, that tapered during the 70s. And Johnson's Great Society went on through also the Nixon administration. I think that's a very analogous way of looking at this economically speaking. It shows you it's on both sides of the aisle. The question is, are we done with the Fed in the longer term, whether or not we have a recession at some point and they have to lower the short end of the curve? We look at long-term borrowing costs. I think the biggest risk is the 10-year waking up at 6%. Now, I say that because that's a level that would affect the economy finally. And that's one of the bigger economic risks that we look at, forward 5 years. Think of things like mortgages, think of auto finance, think of corporate lending. That's when things would finally get lethargic. I think the one place that really is not dealing with that is the stock market. The stock market acts like there's nothing going on. There's not tight short-term rates, and it's chugging along on the back of a good economy. But like we said, it's bolstered by federal spending.
All right, I want to get over to Mike McKee right now, our international policy and economics reporter here. Did you have guns and butter in your economics class?
Oh, absolutely. Yeah. But that was the Lyndon Johnson era, too. Yeah. Guns and butter, Vietnam, inflation, and we saw what happened there. Tomorrow, we're not going to have much of a change in inflation. The CPI forecast, at least according to the median of economists surveyed by Bloomberg, as they say, will show a decline in the headline number that might be somewhat impressive, but it's not going to have an impact on the year-over-year number because of base effects. Core doesn't move very much either. So what is the Fed going to be looking at? Well, primarily, they will look at, as will we all, housing. What is happening with housing? I want to show you a chart here that tells this story very well. This is the harmonized inflation chart that shows US CPI the way that the Europeans do it. Why did the ECB cut rates? Well, because their inflation rate is lower. Ours would be too if we didn't have the complicated way we measure housing. And you can see that here. The blue line is the way the BLS measures CPI, and the white line takes that out. So you could see why we're in different places, and what the Fed needs to see is that blue line coming down towards the white line. When will that happen? Well, go back to Jay Powell's news conference at the last Fed meeting, and he said, we don't really know. That's a problem for them because at this point, the exact timing of it, they've learned lags are longer, he said. We now think significantly longer than we thought at the beginning. And so while they're confident it will come down, they're not confident in the timing of that, which leaves everybody on Wall Street waiting to see what they say about timing tomorrow. The forecasts are at this point that December's the only thing that's baked in. November's a strong maybe, about 90%, but nothing before that really gets over 50-50. So does the Fed cut once? Does the Fed cut twice? Or does the Fed not cut at all this year? We might learn a lot at 8:30 tomorrow with CPI.
I'm sure we'll learn a lot either way. Mike, thanks so much for joining us. Mike McKee there, Chief Economics and Policy Correspondent. Cole Smead is still with us, Smead Capital Management CEO. What's your take on what the Fed is going to do? You said you don't want to be in his place, right? But he's got to do something, or I guess he could do nothing. Which do you think he chooses?
Well, I mean, if you look at actual loosening or tightening, things have got looser all the while we've had very tight short-term rates. So I think if you look at the money growth, think of all the talk of private credit right now, for example. That's loosening, that's loose policy, that's a lot of money sloshing around. So the question, I would use, Bloomberg opinion person Larry Summers as an example. Larry's been arguing that if you look at R&D and software as a percentage of fixed business investment, it's 37% of the economy. It's never been so high. We are less tied to the credit cycle as an economy in our capital investments for business, and therefore, call it the R star, if you go to the economics world, is plausibly higher because higher rates are what will finally affect the economy in a way that in the past, when we were more tied to the credit cycle, it was lower nominal rates that would affect us. So it's kind of like if this hasn't slowed the economy down at low fives, and this hasn't caused a recession, what short-term interest rate would is kind of the plausible question. You haven't ran into that yet. And so we think a lot about that. But, again, where that affects the economy is not on the short end of the curve. It's on that long end of the curve. That's where you'll actually see the economy change because, that would be where the long-term inflation expectations have shifted. We're not there yet. But if we sit here in 2 years and we still have the sticky inflation that isn't going away and we continue to ask why, I think you'll see people give up hope that the Fed can manage it. Again, that's not their fault,
right?
But that's what they'll have to deal with.
You seem to, though, at Smead Capital, be still placing bets on the consumer, on the economy. Amex is one of your top holdings. I'm looking here, Lennar, Simon Property, D.R. Horton. So in the housing sector, State Street, J.P. Morgan. Interesting that we saw PIMCO come out with a warning about regional bank failures in the U.S., saying that they expect, because of a very high concentration of troubled commercial real estate loans on their books, some failures. But PIMCO co-founder Bill Gross, he was on the close yesterday, and he said he likes some of the regionals. Take a listen.
I've bought some regionals today, KEY or Truist TFC or Citizens CFG. To my way of thinking, are very attractive investments for the immediate to long term.
So, Cole, what do you think about, the regional banks? I mean, he's picked some that he thinks are well reserved against any failures, but clearly CRE is a problem.
CRE is a problem. We started nibbling on the regional banks last fall. We bought Western Alliance, who obviously was in the tumult of last spring, Fifth Third and M&T. The better prices were in the heart of the last spring, to be downright honest. But, to your point, being able to buy those at a discount to book, and those are businesses that produce over 10% return on equity. If you can do that in banks and they can sustain that level of returns, you make good money historically. I would also point out Buffett in the 2023 shareholder meeting, he pointed out to shareholders, if the Bank Holding Act of 1969 had never come about, I would have never gone into insurance. I mean, that's a massive statement. One of the largest insurers in the world. For him to say that, he was saying, hey, I find banks interesting, but I can't get highly involved. So I think that is an interesting arena. But here's a better way of thematically thinking about this. All these investors, people are taking too much risk in the stock market. I'll call it baby boomers that are in the 70-30 that are really sitting 90-10. What they're all trying to do is find an overly consistent business, and those things are very overpriced. If you go look at a lot of the staples, a lot of the consistent blue chips, they're stupidly priced, to be honest. So we look at this world as, it's like Buffett said in the 96 meeting, it's a lumpy 15 rather than a smooth 12. You're looking for a business that has more earnings volatility, but producing higher returns, and yet because it's not so consistent, people aren't wanting to give it a multiple. So that's why banks, that's why energy business, that's why malls, because they are lumpy, but at the same time, you're getting so much better prices for that lumpy level of return relative to the smooth blue chip consistency.
Looking for that value. Listen, Cole, I got a question coming in from a viewer for you. Kind of going back to the Fed, the difficulty that Jay Powell is in because of the data discrepancy. Viewer says, Cole, can you give us your thoughts on the difference between the establishment and household surveys in terms of the labor market?
Oh, that's a wonderful question. And Mike was obviously talking about this a second ago. I think we should scrap the owner equivalent rent. It's a terrible way to do housing. It's funny, we have like Redfin and Zillow, and we have these great services that want to provide all their data free because they want to proliferate their brand. And why aren't we using that data? It's publicly available. It's market-based data. So that's the one part I don't get. Why are we still sending surveys to people and saying, let's survey your prices? If you already own a home, you're not the marginal buyer. You're not shifting marginal prices. I find that to be really problematic. I would argue that OER was understated early in the pandemic. Now it's slightly overstated relative to then. And I think that, therefore you're not getting the real-time data. And like Mike was saying, that's going to affect how you calculate the CPI at any given time.
But can you look through that? Can you use Zillow and Redfin's data? Can you look through that and see a truer picture than the Fed can?
Yeah, I think the truest picture is tight supply. That's what the Fed can't do anything about building houses that are not there. So, did high rates incent builders to go out and supply the market? The answer is no. They've backed off on their numbers. So we went from a tight housing market with low rates to a tight housing market with high rates with less new homes being built. We will not end this with tight supply. You cannot ruin housing by having tight supply. It's like the capital cycle. You hear like Marathon and those guys always talk about capital cycle, and the reality is it's a capital cycle theory. With tight supply, that's good for the economics of the maker or the owner of that asset. And if you cannot oversupply the market, you can't really ruin the economics of housing. I don't think tight rates, like I said, are going to change that. I think one shift we can have in housing would be when call it a millennial or a Gen Z wakes up and says, you know what? It's not about getting a low rate. It's about fixing my rent so that future CPI effects on my rental will never affect me again. That zeitgeist where people say, what if this is an inflation hedge and getting it locked in now will help me? I think that will be the psychological changeover we see in housing. And that would be the only way you could really eventually alleviate the supply issue because people would get past the rate itself.
I mean, you're coming from Phoenix where we've seen housing booms and busts.
Yeah.
And what's that area like right now? I mean, it's a place where we've seen huge growth, where we've seen a ton of immigrants come in.
Yeah.
Tell us about Phoenix.
Well, we get immigrants from the great state of California primarily. So, and by the way, California.
Documented.
Yeah, I was going to say California bashing is one of our favorite sports too. So, to your point, I think Austin was #1, but we were #2. We grew our millionaires more than any other city as a percentage of what we had over the last 5 years. And I mean, it doesn't matter whether they're talking New York, Chicago, LA. We are just collecting a lot of people, but also a lot of wealthy people. We have a 2.5% flat income tax. That's crazy low. I came from Washington. I was one of those people that moved 4 years ago, not because of the pandemic, but again, not dissimilar to those people that made that transition. I've never enjoyed paying taxes in my life like this because what I get. To your point, the difference is it's not a well-established place, so the culture of it is still in the making. It's the youngest state of the lower 48. So I look at that. The main thing for Arizona, and I'll use the Odd Lots podcast. They had Chase Emerson on from Emerson Land Holdings. They talked about water and land, and the New York Times article saying they were going to run out of water. And I think Tracy and Joe did a wonderful job of fleshing that out with Chase, where they just laid out the fact that in Arizona you have to have 100 years of water rights to even get a permit. Okay, so the idea that these places aren't going to grow, they're going to grow a lot. Where are we going to grow? We're going to grow in places like Arizona, Texas, and the South. Cheap land always drives housing. In the case of the West, it'll be cheap land plus water.
Cole, great having you on the program. Thank you so much. I hope you drop by next time you're in New York. Cole Smead there of Smead Capital Management. Shout out also to the Odd Lots podcast, Joe Weisenthal and Tracy Alloway. Now, joining us, take a look at some of the stocks moving ahead of the opening bell. Here's Abigail Doolittle. Abby?
Matt, we may have futures down a bit this morning, but we do have some notable stocks that are trading to the upside. Starting off with the shares of GM, the company has approved a $6 billion buyback. This on growth in their EV business, and it follows a 33% dividend boost from the first quarter. So all is well with GM. Turning to the shares of Lilly, they're also sharply higher after hitting a fresh record high yesterday. A panel did say that their Alzheimer's drug is effective and recommended it for approval by the FDA. And then finally, Spotify, after climbing more than 100%, unbelievably, over the last year, Matt, this stock is higher in the pre-market. They are unveiling a new premium plan for $5 for current users that will allow for playlists, use of ease, and other audio tools.
All right, Abby, thanks very much. We'll check back in with you in a bit. Coming up, Apple entering the world of AI.
I thought it was a historical moment for Apple because this is really now, as much as we talk about the generative AI from an enterprise perspective, the consumer AI story is going to go through Apple.
We'll take a look at the future of Apple next and its partners. This is Bloomberg.
I thought it was a historical moment for Apple because this is really now, as much as we talk about the generative AI from an enterprise perspective, the consumer AI story is going to go through Apple. This was significant. I believe this will be a catalyst to an AI-driven supercycle over the next 2 years.
If you could make him out from that background, noted tech bull Dan Ives there from Wedbush, speaking to Bloomberg earlier on Apple's AI reveal, but not everybody shares his optimism.
Apple's typically not the first to a new product category, but they're also always the best. You saw nothing today that's better than the competition. You saw nothing today that's different from the competition, except marketing and a focus on privacy, right? So that's the difference here. They're not the first, but they're also not the best, and they're not the most advanced. They're here extremely late, and they showed up to the party without a gift, right? They didn't bring much new to the table here.
Joining us now is Bloomberg Tech's reporter Jackie Davalos out in San Francisco, back from Cupertino. Jackie, interesting take there from Mark Gurman. If he is right, that's a pretty disappointing WWDC from Apple.
You know, if you've been a Bloomberg subscriber to Mark Gurman's newsletter and have been watching Bloomberg, you knew what to expect. And sitting there waiting for this big reveal that really never came was a little bit, you know, it fell flat, and you could feel that in the room, especially when, you know, you had to sit through an hour and a half of these announcements of somewhat incremental upgrades to their operating system. And we were just waiting to see what the big deal was going to be with its AI features. Now, to give them some credit, Siri is getting a big revamp. The main thing here is that Siri is going to be able to understand what you're doing on screen so much better and actually be able to understand what you're saying in conversational language, so you can tell the digital assistant, hey, open up my text messages. Hey, can you look up a dinner reservation for me in my email? That, I think, was one of the bigger upgrades that actually surprised me for the better.
But they're doing it with OpenAI, right? Because it seems like they haven't got the ability themselves. So many companies out in Silicon Valley surrounding you have done an incredible job, right? From Google to Facebook. And why isn't Apple there at the table? Why do they have to license someone else's technology?
Because they were late to the party. You know, Mark Gurman's newsletter today really outlined how they were actually working on a lot of this generative AI technology, but then came along ChatGPT in 2022, and they really had to speed that up in a way that they were just not able to do. They take their time because everything that they release is just really perfected, it's polished, and so they're not going to release something that isn't ready. And frankly, they needed to show their consumers something, and they had to have the help of OpenAI to do that. Now, they're going to look for other partners here. They were very forthcoming about that in a separate presser with some journalists, that they're going to seek the help of Google and Google's Gemini. They were also in previous talks with Anthropic. So this kind of mission that they can't do it on their own is pretty unique, but just exactly how they bring their own technology to the table, I think could be a game changer because, like Mark said, they're never usually early to the party, but when they do release something, it ends up not disappointing.
One of the interesting, I think one of the most interesting things was not an Apple announcement, but Elon Musk's response. He says if they integrate OpenAI's technology at the operating system level, he's going to ban Apple devices, from his physical businesses? Is there a possibility that he's going to stop offering CarPlay features in his Teslas?
It's hard to say what Elon is thinking when we just have to kind of take his tweet for his word these days. But what we do know is that Apple really emphasized privacy. They made sure to tell users that if Siri is pulling something from ChatGPT, it's going to ask for your permission, and it's not shipping data off to OpenAI unless it tells you about it. There's going to be an opt-in feature for these new tools. Now, Elon Musk, let's remember, has his own competing AI company as well. There might be some motivations that aren't totally clear in the tweet, but it's sure, he was quick to enter the chat on the heels of this announcement, and he's probably not going to be the last.
Jackie, thanks very much. Jackie Davalos, tech reporter out of San Francisco, talking to us about Apple and Elon Musk. Coming up, we're going to speak with Victoria Fernandez of Crossmark Global Investments at the opening bell. This is Bloomberg. Taking a look at futures, we are down across the board, but of course coming off from the record highs where we closed yesterday. Time for our morning calls now. We'll look at some of the analyst recommendations on Wall Street this morning. First up, JP Morgan downgrading Cleveland Cliffs to a neutral. It's a hold equivalent. The firm sees weakening fundamentals, growing CapEx needs, and a lack of near-term growth for the steel producer. Next up, Comcast gets its only negative analyst rating. Exane cutting the company to an underperform. That's a sell equivalent, saying it's at a tipping point. And finally, D.A. Davidson is upgrading Apple to a buy. The firm says that the AI capabilities that were shown yesterday will be leading to an iPhone upgrade cycle. I guess you have to have the 15 Plus or the next one, the 16, in order to get the goods that we saw at the Worldwide Developers Conference yesterday. Coming up, Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments, joins us. We'll talk to her about what we should expect from the Fed and CPI tomorrow. This is Bloomberg. This is the countdown to the open. I'm Matt Miller. We are moments away from the start of trading. Futures are down, but after we hit another closing record high yesterday, 5360 on the S&P 500 as the index rose into the close. Right now, we're just listening to the opening bells and watching the trading here commence. Futures, you can see off S&P futures down about 0.3%. We've seen Apple fluctuating. It's definitely one of the stocks that we're going to be watching today. First off, here's the euro. 107.23, so holding at that 107 handle. The 10-year at 443, 445, and NYMEX crude at 77.62. Apple really a big one to watch, although maybe not a big mover today. It's been bouncing back and forth around the zero level. Right now, up about 0.5% at the start of trade, $1 a share to 194.35 after introducing its AI for the rest of us plan yesterday. It says it's going to team up with OpenAI and others to make Siri smarter. You can see Google rising as well there, about $1 to 176. Get over to Abigail Doolittle. She has more on these two Mag 7 members.
This is an interesting one, Matt, because yesterday for Apple, it was a bit of a sell the news moment after that Worldwide Developer Conference 2024. Yes, they're firmly in the AI game, but as Matt Gurman said, they really didn't bring a gift to the party per se. Nothing so exciting. I mean, if a partnership with OpenAI is not going to get that stock to rally, I'm not quite sure what will. But today we do have a little bit of a relief bounce, up 0.6%. From a technical standpoint, though, Apple firmly hitting up on resistance. It's going to be interesting to see whether or not it can break out of a roughly year-long range. Over that last year, up just 5%. Alphabet, on the other hand, Matt, over the last year, up closer to 40%. Some analysts are saying that Apple's lack of real news at that conference, good news for Alphabet. At least that is what Morgan Stanley's analyst Brian Nowak is saying, that he came out of that WWDC keynote feeling, quote unquote, more confident in the AI leadership of Alphabet's Google and the continued relevance of the company's core search product, because of course analysts have been fearful that AI was going to take something from Google search, but it seems that we don't really have to worry about that, at least quite yet.
Yeah, Apple, as you said, kind of a sell the news trade yesterday. It was off. I couldn't decide whether that was just disappointment with what happened or whether or not people had been buying the shares into the Worldwide Developers Conference. How does the chart look? I
think it's exactly both of those factors, Matt. That chart is really pretty striking in the fact that over the last month to 6 weeks, the stock had rallied 20%, maybe into the conference, hoping that there was going to be some sort of a big announcement. It was satisfactory, but it wasn't an over delivery, so they sold the shares off. Given the fact that it did hit up against resistance right below $200, it really seems as though Apple or something macro, it could be the Fed, will have to come in to help the stock go above that resistance. If not, very likely to go right back down into the range. And of course, when that happened last December into the April bottom, it was almost a bear market. So stay tuned. There could be some more volatility ahead for the S&P 500's second largest member.
You know, one of the Apple, I mean, if you listen to Bloomberg Surveillance on the radio, Paul Sweeney is always asking Apple to give more money back to shareholders. It's not coming out the way he wants it to, but General Motors yesterday, Abby, approved a new $6 billion buyback plan after completing a $10 billion buyback plan that was approved last November. Those shares rocketed up 4%. I guess the EV business is doing a little bit better than expected, and they're up again today.
That's exactly right. The stock up 1.7%. GM doing very well, and that the green business, the EV business, they're citing growth there. So they really are able to do that financial engineering and return money to investors. That 33% dividend that was boosted by 33% in the first quarter. And then this $6 billion buyback, investors really like it. Those shares up 1.6% after that rally yesterday you talked about.
All right, Abigail, thanks very much. Abigail Doolittle following the stocks for us. Joining us now to talk more about the broader market and the economy is Victoria Fernandez. She is Chief Market Strategist at Crossmark Global Investments. Welcome to the show, Victoria. Thanks so much for joining us.
Yeah.
We have obviously a big day tomorrow with the Fed and CPI. Why don't you tell us first off your take on inflation and how that plays into your investment strategy?
Yeah, so I think inflation is probably stickier than what most people think. When you look historically, look at the 25 years prior to COVID, the pandemic, you had service inflation at 3%. You had goods inflation down around 0.2%. So I think when people look at the difference between the two and you look now and say, well, we should be right around where we are on the services side. And that's where everyone is so concerned that it's not coming down. It's the goods inflation that needs to come down some. And how is that going to happen? Well, I mean, we've got to have more globalization, and I don't think that's where we're headed right now. So when
higher rates. I mean, higher rates would bring down goods inflation, right? If I had to pay more on a loan to buy a car, I would probably buy a cheaper car or maybe skip that for now.
That's exactly right. And when you look at the consumer, I mean, the consumer's driving this economy, right? And you don't want to get in the way of the momentum that we're seeing right now. But so many things are out there saying, hold on, this economy has got to slow down, consumer demand being one of them. Non-discretionary inflation is what people are looking at. But you look at discretionary inflation versus non-discretionary, 6% year over year for non-discretionary. These are things people have to buy.
Right.
They don't have a choice. That is hurting the consumer. So for our investments, we want to have some diversification. Do we have exposure to these big growth names? Yes, of course we do. But we're adding to the value side, to some of the staples names, because we do think we're going to get a pullback, whether it's a recession or not. It seems like the consumer's hanging in there, but we definitely think we'll get a weakening economy.
I mean, even discretionary purchases, I look at car sales all the time, and they just continue to march higher, even with prices at these levels. It always stuns me. Nonetheless, the Fed is not going to raise rates, right?
Yeah.
I mean, the bar for a hike is much higher than the bar for a cut. What do you expect from Jay Powell and co. tomorrow?
I don't expect much in this meeting tomorrow, except for I think Powell will try to push back on the market in regards to when the first cut is going to be, because we've had 4 central banks already come in and do cuts, ECB, the latest one. But I don't think just because we had one cut that we're all of a sudden going to be all in on an easing cycle. You know, we tell our clients, like, when the market does well, you trim some of your positions. I think that's what central banks are doing. Let's trim a little bit of where we are and then wait and see. I think it will be interesting to see if Powell focuses more on inflation or on the labor market. That might give us a little bit of clue as to the timing. Our investment committee is a little split on when we think that first rate cut will be, but either September or December is our outlook. I think look next year for more of your rate cuts to come into play, but be careful what you ask for, right? Yeah. Having the Fed lower rates means the economy is weakening.
Right. But if we only get one rate cut, I think you're right in that, they can afford to do it. That's what the ECB did. We've seen the Bank of Canada do that. What does your investment committee like right now? What stocks do you buy, or what assets do you buy dealing with this period of uncertainty, which, by the way, we see in the data as well, some pointing higher and some pointing lower?
Exactly. So you want companies that you know can withstand the volatility that's going to be in the market. It doesn't mean it's one sector in particular. So you're digging into those balance sheets. You want good cash flows, right? You want return on equity. You want sustainability and predictability of earnings. So names we like. Healthcare has really taken a hit over the last year. So a name like Cigna we own in our portfolios. We like names like that. We like exposure to American Express or Visa. We know the consumer's looking to slow down, but you look at the balance sheets of these companies and the cash flows they have, return on equity of 35, 40%, plus they pay a dividend. These are the types of companies you want to continue to have in your portfolio.
What do you think about the regional banks? There was a warning out from PIMCO today. Some of them have too much exposure to commercial real estate. The home builders, right? Real estate is the only S&P industry group that's in the red this year.
Right.
What do you think about that whole area for the consumer?
So if we get rates coming down on a sustained basis, then I think real estate is an opportunity you could look at. Like REITs will start to do a little bit better there. But there is some concern. And you look at the housing market right now, housing leads CPI by about 12 months. We're seeing housing prices continue to move higher because supply of existing homes is so low. So to me, that means it's probably not going to be an area of growth anytime soon. No one wants to trade in a 3% mortgage and go get a 7% mortgage to replace it. So I think those are areas you have to be cautious in. And a lot of it is going to have to do with where rates go. If we stay in this 4% to 4.5%, 4.60 range for a while, you're probably not going to get a lot of movement in those areas.
Bill Gross was on the close yesterday talking about a wide gamut of things, but one of them is MLPs. He always comes back to that. He loves those MLPs. And you're down in Texas, right? What do you think about MLPs? What do you think about the energy patch right now?
So obviously, being in Houston, we have a lot of exposure to the energy sector. And I think because of some of the pullback that we've seen there, you have an opportunity to get into some of these names. We like those involved in transportation. It's difficult sometimes on the production side, but because the U.S. is producing more, because we're exporting more, and because you have such strong balance sheets, we go back to the balance sheets, the cash sitting on the balance sheets of these companies, this is where you can invest and put a little bit of money to work. We saw Brent go back above $81. WTI is close to, 78, 79 this morning. Yep. Obviously, you can have some geopolitical events that cause some volatility there. But I think based on what the U.S. is doing, I think you can put some money to work in those areas.
We were just talking to Cole Smead. He's out in Phoenix, obviously a big fan of the economy there. They moved there from Washington. You're down in Houston, as you mentioned. Isn't it hard to do business when your energy grid continues to collapse? I mean, isn't that an important part about doing business?
It's an important part of everyday life, right? To have that going. And yes, we did have some issues a couple years ago when we had the freeze. And I mean, I left Houston a few days ago. It's mid-90s. It's hot there. Lots of air conditioning that's running. But it's a great state for business, and it's the infrastructure component that we have to continue to build out. I think we'll see a lot of work in that area, especially as we've had so many people move into the state. So we've had more tax generation coming through. That can help with some of the infrastructure issues. But it's a great place to live and to work. So we're going to tell people to come on in.
All right, Victoria, thanks so much for joining us. Really appreciate you coming up to New York and joining us on the close. The close. I've been watching Romaine. I've been watching Romaine and Alex and Scarlett. Their relaunch was fantastic yesterday. Recommend you tune in again at 3 o'clock today. Of course, this is The Open. Coming up with small business optimism at its highest level this year, we speak to Chase for Business CEO Ben Walcher on how owners need to cycle-proof their businesses. This is Bloomberg. U.S. small business optimism edging higher in May to the highest level so far this year, with firms growing less downbeat about the economy's prospects. And we also just got a couple of headlines from the World Bank upgrading its outlook for U.S. GDP growth to 2.5% from 1.6%. They're upgrading their entire outlook for global growth to 2.6% from 2.4%. So it seems like the economy is ticking along. We got a great jobs number last Friday, better than had been expected. Let's talk to somebody who represents small businesses in a great way. Ben Walcher is Chase for Business CEO, and he joins us now to talk about small businesses and the U.S. economy. Ben, we continue to get signs of optimism here, even with the Fed above 5%. How do you gauge the U.S. economy and the speed at which it's running right now?
Hi, Matt. It's great to be here. I would say a couple of things. First of all, we look at it from the perspective here at Chase for Business from small business. I think overall you see businesses looking inward saying my business is doing okay. Generally, they're pretty optimistic about their own prospects. There are some things that are cautionary. I would highlight, if you look at the NFIB survey that just came out that you referenced, it did tick up, but it's still running along at sort of an all-time low in terms of the range. And that's because they say my business is doing fine, but I'm worried about the world out there. And everybody knows that uncertainty is the toughest thing for business, and we still see a lot of concern about uncertainty out there. Inflation continues to be a worry, but in particular, inflation with respect to wages. Workers are still demanding more wages. I understand why. It's tough out there. Costs are going up. But wages are an input cost to small businesses. They're not as well equipped as large businesses to handle it. So there is some caution to temper that optimism.
So we're still feeling the kind of vibe session that was last year's word for it, because we have growth, but you're telling me business owners are concerned. I know from the NFIB survey, 22% said their main concern was inflation, 20% said their main concern was labor. How do you hear it from the small businesses that you represent, that you work with?
Exactly the same as that. I mean, these themes have been out there for a long time, longer than we thought they would last, and they still are out there in terms of the things that small businesses are concerned about. So we do see that caution. However, I would say that it varies by industry. So if you look, for example, there are things that did particularly poorly during the pandemic that are now doing quite well, at least from a demand perspective. Demand for restaurants is off the charts. Now, their costs are high, but they're seeing strong demand. Anything having to do with home improvement, seeing very strong demand, very strong performance from small businesses. On the flip side, take a look at something like trucking. You saw a surge in trucking investment during the peak of the pandemic, when so many goods were being rushed around to people's homes. And now there's a bit of a glut of supply, and so you see more slack there in the supply-demand equation. So it depends really on where you sit in the economy as to what kind of pressure you're feeling.
So small business owners worried about inflation. Their employees are asking for higher wages. they're raising prices, I guess, too. It doesn't feel like you think the disinflation is continuing.
I think it is, yeah. I mean, it's slower at a slower pace than it was before. But, I'm a big fan of when people tell you how they feel, we should believe them. And they're telling us that the increase in producer prices are still a squeeze on their margins. So I think the demand is still there to offset it for the moment. So their margins are getting squeezed a bit, but they still feel growth. At least a third of them tell us they want to borrow and invest. 2/3 of them tell us that their business is performing acceptably, if not well. And so I think overall, we're sort of in that Goldilocks space for the moment. If nothing throws that off track. They are concerned about interest rates, although I remind people, often that these are sort of more normal interest rates, not high interest rates, and that their business models need to adjust to interest rates that are anywhere in the 5 to 7% range, because that's sort of in line with long-term averages.
Right, and you said, what, a third still want to borrow and invest, so they don't feel like, or you don't see these interest rates as being restrictive?
They are restrictive relative to where they were before, certainly, but I don't think they're restrictive relative to the places where people see demand. And the other thing I would say, Matt, is we still see business formation ticking along at a rate that is well above where we were pre-pandemic. It spiked in 2020, it came back down in 2021, and it's now settled at a pace that is still significantly higher than 2019. And not in the way that we see, if you look, whenever we see an economic downturn, we see a spike in business formation. That always happens. But this isn't like that. This is month after month at a steady rate that is about a third higher than it was in 2019. And that does bode well for the economy.
What are the size of the businesses that you serve? How many do you serve? And how important is tomorrow's decision to your business?
Look, I serve businesses that are generally between 0 and $20 million of revenue. We serve about almost 4.5 million of those businesses, about 4.2 million of those businesses. So it's quite large in terms of its penetration, in terms of our penetration into the economy. I would say tomorrow's decision, for our clients, they need to be able to run their business throughout the cycle. So one individual decision, if one individual's decision is going to make or break a business, that business is running along at a pretty perilous clip anyway. We advise our clients to be able to handle a range of scenarios. They typically can, and they invest through the cycle in a way that's sustainable. So I don't see them hanging on every twist and turn that the Fed takes.
Ben, just want to ask you about regional differences, because we've had a couple of guests on today from Arizona, from Texas. They talked to us about the growth they see in Austin, in Phoenix. Are you seeing big regional differences across the country?
We aren't, and we look hard for that. Look, I'm from Texas. I live in New York, so I understand that it's a different business environment. I'm sure there's a lot of people out there, touting the success of their own area. There's a bit of net migration, but ultimately we see strong business starts in Texas and Florida, and we see strong business starts in New York and California, and we see some of our best growth in those states as well. So we really don't see the regional differences at the small business level that you hear about, maybe from the overall GDP story. We see health across the country.
Fascinating stuff. Great intel, Ben. Thanks so much for joining us. Ben Walter, Chase for Business CEO, serving, as he said, 4.2 million small businesses between 0 and 20 million in revenue across the country, and they see health no matter what region they look in. Now, for some of the sector price action this morning, let's get over to Abigail Doolittle again. Abby, what do you see in the sectors?
This is pretty interesting, Matt, because right now we have a decline for the S&P 500 of about 0.6%, so the worst day of June. It is a broad-based decline from a sector composition. 10 of 11 sectors are lower. Financials down the most, down 1.3%. Then industrials, utilities, consumer discretionary. So you really are not getting a break. And it's interesting because yields are down. A lot of those are sectors that should trade higher when yields go down because their dividends look better, but that's not the case. Tech hanging on to a tiny gain of 0.1% or thereabouts, with Apple and Nvidia higher, but on the other hand, leading to the downside, Microsoft, JP Morgan, and Tesla. Let's dig in just a little bit more to utilities, because on the year, they are sharply higher, one of the best years since 2021, or the best year since 2021. But from the recent peak, down more than 5%. This is over the last 7 days, down 3.7%. Today, down. It's not entirely clear why, but nearly all the members today of that index are lower, led by Nextera. Apparently, they reaffirmed numbers, but investors not liking it. So weakness right across the board here from a sector standpoint, Matt.
All right, really interesting stuff. Nextera, interestingly, one of the stocks that Bill Gross mentions he likes and owns when he was talking with Romaine, Alex, and Scarlett on the close yesterday. Abigail Doolittle looking at the sectors for us. Coming up, the market-moving events you need to be watching today. That's next in our trading diary. This is Bloomberg. Time now for the trading diary, what you need to be watching this week. The Federal Reserve, of course, begins its two-day meeting today, and tomorrow we're going to get all the specials on that. Oracle reports results after the closing bell, so stay tuned to see how they're doing. Tomorrow we're going to obviously get CPI data as well. Those are really the two twin events that you need to be watching, plus the rate decision at the end of the two-day meeting. On Friday, we're going to get the University of Michigan consumer sentiment data, another read on how the people feel that this economy is doing. This has been the countdown to the open. I'm Matt Miller. This is Bloomberg.